all you know is that it's worth, all you know is the last traded price, which may have been 2 days ago or 2 months ago. But it is up to you to make an independent valuation of what that stock might be worth, and therefore whether or not you want to exercise. Now, because we don't know what that stock is worth, the exercise process, remember last week we talked about a process called automatic exercise or exercise by exception, in which if your option is in the money by at least a penny, it will automatically get exercised. If we don't know what the underlying stock is worth, we won't know whether or not that contract is in the money. So automatic exercise is going to be removed, which means the only way, again, if you remember from last week, the only way to exercise that contract is to do it manually through your broker. If you do decide to exercise that contract, again, have a discussion with your broker to see what that procedure is and how it works. But as I mentioned, I want you to pay attention to these numbers, and you've probably seen these before as well. 72, 6, and 22. 72 represents, out of all the contracts that are traded, 72% of them typically get closed out ahead of expiration. About 6% of all options get exercised or assigned on expiration, and the other 22% expire worthless. Now, why is this important? If there's a trading halt and it continues through expiration, remember, if the stock is halted, the options are halted as well. So that means, boom, 72% get closed out ahead of time, not you, right? You don't have that ability to close out that contract any longer through a buy or sell to close transaction because you can't trade the options. So that only leaves these two scenarios, either exercising the contract or letting it expire without value. Let's say we've got a long put option and you go to exercise it. If you don't already own that stock, exercising a long put requires you, in exchange for the strike price times 100 that you're going to receive, it requires you to deliver that stock to the assignee. Well, if you don't have that stock in your account, either you or your trading firm needs to go out and get it in order to deliver to the assignee. If shares are halted, you cannot go out and get it. You can't go into the open market and buy that stock. Your trading firm can't go into the open market and buy that stock for you to lend it to you so you can deliver it to the assignee. So now, guess what? You can't exercise either. And what's left? The contract expires worthless, regardless of any value that it might have. If you can't close it out ahead of time because it's halted, and if you can't exercise because you don't own those shares or your trading firm will not allow you to exercise, then guess what? No matter what that contract is worth, it's going to expire worthless. Something that, it's